Hey guys, today I'm going to talk about a bull call spread. I think I already did a video on this one, but a friend of mine, asked me for a few more details, so I thought I would go in depth a little bit more and not just tell you what the trade is, but also tell you why it works. This is, again, it's a bull call spread. This is a vertical debit trade. So since it's a debit trade, we have to pay money to get into it. And since we are paying money to get into it, we already know that the most we can lose on the trade is however much we paid. Now, when we're doing a vertical bull call spread, it's called a bull call spread because it's bullish. I know, I'm stating the obvious, but you know, I never know who's going to be watching, so yeah, so it's a bullish trade. You do one of these trades when you think the underlying stock or ETF is going to go up. And in this particular case, I went all the way out to the January of 2016 calls. These are actually LEAPs, which stands for Long-Term Equity Anticipation Securities. I purchased for the SLV ETF, which is the silver ETF. I bought the 34 call and I sold the 36 call. Both, of course, with the same expiration date. That's why it's called the vertical, because they both have the same expiration date. Woo! This is all making sense, right? Okay, I'll go through it again slower after I just go through the overview. Okay, so it's a bull call spread. I purchased the January 34-36 call spread. The total cost of the spread was 8 cents per contract share. So for each one contract that you buy, it's going to cost you $8 because there are 100 shares per contract. So I bought the 34. This was a couple weeks ago too. If you check the current option chain for today, which is August 14th, the numbers are actually a little lower. I could have purchased this spread for about half the price I got it. I think it was a couple weeks ago when I first bought this. So when I bought it, I paid 37 cents per contract for the 34 call. And I received 29 cents per contract share for the $36 strike price call. So if I paid 37, I received 29. The total cost of the trade was 8 cents a contract share, and that comes out to, as I mentioned, $8. Now, real quickly, I just want to calculate the maximum reward. The max reward on this is the difference between strike prices of the call you bought and the call you sold minus what you paid for the spread. So the difference between the call the call you bought and the call you sold is 36 minus 34, that's $2, minus what I paid, which is 8 cents. So the maximum reward on this particular vertical spread is $1.92 per contract times 100 shares, of course. So I paid $8 and the maximum reward is $192. That's if the trade goes my way, and that's if silver closes above the strike price of the call that I sold. So in this case, I need the stock to go up and to close on the 3rd January in, the 3rd Saturday in January of 2016, I needed to close at or above $36 per share, and then I will get my maximum reward of $192 per contract, or if you calculate that, it's a 2,400%. Ding, 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 ding. That's a really good return. Yeah, it is, right? Over about a year and a half. But still, risk $8 and make $192, minus commissions, of course. Get low commissions if you don't have them. All right, that is the summary version. Now, why does this trade work? Let's go through it. Let's back up here a little bit. I'm going to take these numbers off, and I'm just going to look at what happens to this trade as the price of the underlying ETF goes up. Now, as this goes up, actually, let's not look at it what it does as it goes up. Let's look at it on expiration, and I can tell you why this works the way it works. Okay. Let's say today is it's now January, I don't know, 15th of 2014. No, 2016, because that's the date. That's the expiration date on the spread that I purchased. The third Saturday in January is when this expires. So what I'm thinking is that over the next year and a half or so, silver is going to go up, and I think it's going to close above 36, or I wouldn't have done this trade. I won't go into the reasons for that. That's a different subject. But let's say I'm right. Let's say on this date, January 15th of 2016, at some point, a few days before expiration, let's say that SLV is at 40. It is above the strike price of the call that I sold. Okay, so remember I bought the 34, I sold the 36. What happens? What happens if I hold this through expiration? Let's do that first, and then we can talk about what we actually do. If we hold this through expiration, we know that our brokers are going to automatically exercise any option that is in the money. If it's in the money, that means the person who owns the call is going to want to exercise it because they're going to have some money coming to them. So in this case, we own the 34 strike price call, and that's in the money by $6. How do we know that? Because if they exercise this, they're going to give us 100 shares at $34 a share. That's what we're going to pay. And then immediately, when the market opens on Monday, the following Monday after expiration, assuming that the stock price is still right around $40 where it closed, we assume we're going to get $40 for that stock because we're going to get the stock and we're immediately going to sell it back into the market and take our money and run. So if we buy it at 34 and we receive 40 for it, then we are going to net $6 on that trade. So we know that our 34 strike price call at expiration is going to be worth $6. Hopefully that's making sense. Now, when we sell a call, we know that we have to provide the stock to whoever bought this call. We're obligated to provide that stock to them for $36. When we sold that call, we said, okay, I agree that if silver is above 36, I will sell you 100 shares at $36. That's what it means when you sell a call. You are obligated to sell the underlying stock at that strike price. So what's going to happen here is the broker is going to automatically exercise that call option, And when they do that, they are going to, I get confused. You know, I've been doing this for 5 years and I still get confused. All right, so they are going to force me to deliver 100 shares of stock. Well, I don't own the stock because that wasn't part of my trade. I only sold the call. I bought a call and I sold the call. I sold the call, but it wasn't a covered call because I didn't have any stock. I just sold the call. So in order for them to process this short call, they have to go out into the market, buy the shares using my money for $40 because that's what the market's going to charge me. If I go out and buy the shares on this date, I get to pay $40. I sold this call. I agreed to sell the stock for $36. But if I have to go get it, I can't get it for $36. I can get it for $40. So I go out, my broker does this for me, and purchases 100 shares of the stock at the market price of $40. So that costs me $40 there. That's a debit. And then whoever bought the call, the broker takes care of all this. It's no person out there. Whoever bought the call, market maker, broker, whoever, forces me to deliver that stock, those 100 shares, to them because they bought the call. They want to do this. They want to buy the stock for 36 and then go sell it into the market for 40. That's what they want to do. That's why they bought this call. So I have to provide the stock for them so they can purchase it at 36 and go sell it for 40. Well, when I sell it to them, I get $36 a share. 36, that's what I get because that's what I agreed to. That's what I'm obligated to do. So what's the difference there? Negative 40, which is what I had to pay for the stock at the market price, minus the 36 that this person paid me. So this whole trade actually cost me $4. So if we were to process these trades separately, this long call would net me $6 a share, and this short call would cost me $4 a share. So what's the difference there? This is a negative. 6 minus 4 is 2. Okay, there's my $2. That's why this call call spread, excuse me, that's why this call spread is worth $2 at expiration if the stock or the underlying ETF closes above the strike price of the one that I sold. That's a short, hopefully not too long, overview of why this works. So again, now we're taking the $2. That's what we got from this exercise of this spread, but we did have to pay the $8. So what we get is $2, then that's what we get per share. So it's going to be $200 per contract, which is 100 shares, minus what we paid for the spread, which remember was 8 cents a share. Therefore, our net is $1.92 per contract share, or $192 per contract, or 2,400% if silver goes above $36 and stays up there on expiration Friday of 2016 January. Now you can do the math if if the underlying closes somewhere between these two, then you are still going to make money. You'll make money as long as the price of the underlying is above $34.08. That's your break-even price. So your break-even price is the lower strike price, which is the one you sold, plus what you paid for the spread. So we paid 8 cents for the spread, and the break-even point then is $34.08. If the stock closes above $34.08, we'll make money. We won't make the full 192 unless it goes over 36, but we will make something. Now, if the stock or the underlying, in this case ETF, closes below 34, then we're just out $8. We don't get anything. These are both out of the money in that case. Neither of these calls has any intrinsic value. You know, if silver closed at 30, then we wouldn't want to exercise the call that we bought, because why would we want to buy it for 34 when we could get it at the market for 30? And whoever bought the 36 call is going to say the same thing. They're not going to want to exercise that. Why would they want to buy at 36 when they could go into the market and get it for 30? So that's why both of these, in that case, would expire worthless, and that's why your spread would be worth nothing, and that's why you would lose your $8 or your 8 cents per contract share. Now, I don't typically like to wait until this happens. What I mean by that is I don't like to hold these through expiration, because weird things can happen with the broker, and sometimes they don't take care of things the way they should. Even the very best brokers have mistakes. So typically what I will do is I will sell the spread at some point before expiration. And the point at which I sell it depends on what the spread is worth, and how far it is to expiration has an impact on that. So if we get to January of 2015, and for some reason silver goes up to $50, or SLV goes up to $50, then this is going to be in the money. This 34-36 call spread is going to be in the money completely. So that call spread might be worth, and I'm totally guessing here, I have no idea. I'd have to do the math, and I'd have to look at the theta, and I'd have to do a risk graph, and I don't want to do all that because I'm lazy. So I'm just going to throw a number out there. Let's say if in January of 2015 silver is, or SLV is at $50, then these are both in the money. That spread may be worth, I don't know, $1.50. Ultimately it would be worth $2, but there is some uncertainty. I mean, that's expiration's a whole year away. So there's going to be some uncertainty. Even though it's in the money, there will be time value that's going to come out of that spread value. So if it's a year out and the silver has skyrocketed and I can get $1.50 for the spread, I will go ahead and sell that spread for $1.50 rather than waiting a year and trying to get an extra 50 cents out of the spread. Hopefully that's making sense. Also, if I sell it for $1.50, I don't have to worry about it anymore. I don't have to worry about silver going back down and possibly trading back under this. I know I'm going to get something out of it. Just, if you felt like silver was going to fall, you might want to go ahead and take your gains. So this is a trade that you do. You don't have to buy these separately. Your broker will allow you to trade the spread, which helps you get a better price. When you look at the price, it will actually tell you the bid and ask for the pair. You can look at the individual prices. In this case, it was 37 cents and 29 cents. But it'll tell you what the bid ask range is for the spread itself. So in this case, I think the mid was 0.08. It was 8 cents. So maybe the bid ask was 4 cents and 12 cents. So if it's a bid ask of 4.12, then you bid 8 cents and hopefully you get it at the mid. What else? I think that's it. Yeah, I think that's it. oh, if it does take until expiration for silver to get up around this number, and for some reason you want to keep holding it because you want that time value to erode, I will close this. I will close any spread before it expires so that they don't have to execute the trades or exercise the options. So what I'll do is, if it's a $2 spread and it's almost expiration and it's all the way in the money, I will try to sell the spread for $1.98 or $1.99. So I'm giving up 1 or 2 cents per contract share just to make sure that the closing trade gets properly handled. I think that's it now. I'm on Twitter if you have any questions, or Facebook if you know where to find me, or you can leave comments on the video. Sorry for the video quality. I'm still not rich enough to purchase an actual nice camera yet, so apologies if the video is jumping all around. But hey, at least the audio is right, is okay, right? I think so. All right, that's it. Trade well. See you next time.